So let's start with something you have definitely seen in real life. There is always that one friend who says they want to start a cafe, but they don't have enough money to buy equipments or rent a place. At the same time, imagine there is another friend who has some savings lying in their bank account doing nothing. So what's happening here is one person needs money and the other one has extra money. But the two don't always meet at the right time or on the right terms. Now imagine this situation not with two friends but with lakhs of people, thousands of companies, and even governments. Some have surplus money while some need money. Now, how do they find each other? That meeting place is called the financial market. On one side, there are households like us. Every month we save a little. That makes us a surplus unit. On the other side, there are companies and governments that want to build factories, launch products, expand into new cities, make roads and airports. So they need funds. That makes them deficit units. Alone, these two cannot easily find each other. So we need a system that collects money from those who have extra and channels it to those who can use it productively. That entire system is the financial market. And this system matters because if it didn't exist, the economy would move very slowly. Businesses would grow only as fast as their own savings. People would keep money idle, opportunities would be lost, and jobs would be fewer. The financial market keeps the economy alive. It allows savings to become investments and ideas to become businesses. Now, let's break the financial market into two big parts. Number one, the money market. This is for short term needs, and short term usually means borrowing and lending for less than 1 year. So let's suppose Ambani ji has to pay salaries this week, but payments from his client are scheduled to come 30 days later. It's not a loss making situation, it's just a matter of timing. So, what would Ambani ji do in this situation? He will borrow short term funds from the money market to manage this gap. Banks also borrow and lend here to balance their daily cash requirements. Even the government uses this market through treasury bills. See, we individuals usually don't directly interact with the money market, but it affects us. If the money market gets tight, loan interest rates rise, EMIs rise, and overall liquidity in the economy tightens. It keeps things running smoothly in the short term. Number two, the capital market. This is for the long term growth, and long term usually means funding for more than 1 year. When a company wants to expand or diversify or acquire, it needs long term money. If a company wants to build a new plant, launch new product line, or expand to multiple cities, it raises money through shares or bonds in the capital market. This is where we participate as investors, buying shares on NSE or BSE, investing in mutual funds, putting money in NPS or long term retirement plans. When you buy shares, you become part owner of a company's journey. When you buy bonds, you become a long term lender. The capital market helps build things that last. It funds growth, expansion, and innovation. Now, both these markets have two segments. Primary market, where securities are issued for the first time, for example, an IPO, initial public offering, money moves from investors to the company in this market. Now, secondary market. This is where securities are traded after the IPO. Like when you buy or sell shares on NSE or BSE, here investors trade with each other. The company is not involved. The secondary market provides liquidity. Liquidity means you can exit when you want. Without liquidity, investors would hesitate to invest in the first place. So, a strong secondary market encourages more activity in the primary market. This is how the system grows. Now, step back for a moment. A financial market is not a building. It's not just a stock exchange. It is a mechanism that ensures money flows smoothly from where it is lying idle to where it can create value. And because this system is so important, we need transparency, fairness, and rules. That's where SEBI and other regulators come in. We'll talk about them in the next part. For now, remember this: a financial market exists to do one thing: move money to where it can be used productively. When this works well, the economy grows, business grows, investors grow. That's the core idea of finance. In the next video, we'll talk about who runs the financial markets, or SEBI, stock exchanges, clearing corporations, and depositories. Once you understand their role, investing starts to feel much clearer. Subscribe to this channel and don't forget to share this video with someone who may find it useful.